The screen you are staring at right now is lying to you. While the ticker on your phone shows a steady, manageable climb, the actual vaults beneath the streets of Manhattan and London are experiencing a quiet, violent evacuation of physical wealth that hasn't been seen in our lifetime. JPMorgan hasn't just been managing the market, they have been vacuuming the very foundation of it into private, off-book accounts while the retail world sleeps. This isn't a theory or a rumor whispered in dark corners of the internet. It is a documented systemic drainage of the COMEX and LBMA inventories that has reached a terminal velocity where the word depletion is no longer hyperbole but a mathematical certainty. The price discovery mechanism we have relied on for decades, the process by which buyers and sellers determine value, has effectively snapped under the weight of a physical demand that no longer recognizes the digital price. For years, the COMEX has operated on a fractional reserve system where hundreds of paper ounces are traded for every single physical ounce held in a vault. That system works perfectly until everyone decides they want to take delivery at the exact same time, which is precisely what we are seeing play out in the registered silver categories right now. The vaults are being bled dry not by small-time stackers, but by massive industrial titans and sovereign entities who realized the paper game was rigged and decided to grab the metal while the doors were still unlocked. We are witnessing the final days of the paper-silver era, a period defined by artificial suppression and high-frequency trading algorithms designed to shake out weak hands. The price is currently a ghost, a lingering echo of a market that has already moved on to a much more expensive, much more desperate reality. If you look at the vault drawdown charts, the slope isn't a curve anymore. It is a vertical drop into an abyss that the mainstream financial media refuses to acknowledge. The central banks are no longer just monitoring the situation. They have flipped their positioning entirely, moving from the side of the shorts to the side of the physical accumulators. This shift represents the ultimate game over for the short sellers who thought they could suppress the silver price forever using infinite leverage. When the world's largest bullion banks stop selling and start hoarding the window for the average person to acquire physical metal does not just close, it slams shut with a force that will break the financial teeth of anyone caught in the middle. Every ounce that leaves the registered category of the COMEX is an ounce that is likely never coming back to the market at these prices. This is the great decoupling, the moment where the digital illusion shatters and the cold, hard reality of physical scarcity takes over. The headlines will tell you everything is fine, but the empty pallets in the vaults tell a story of a system that has already been hollowed out from the inside. We are past the point of a soft landing. We are in the middle of a systemic reset where the prize is the metal itself, not the currency used to measure it. The fundamental disconnect between what you see on a trading screen and what you pay at a coin shop is no longer a premium. It is a total systemic fracture. For decades, the London Bullion Market Association and the COMEX have dictated a spot price that supposedly represents the value of silver, yet this number has become a mathematical fiction. While the digital ticker stagnates, the physical market is screaming, with retail buyers and industrial giants alike facing wait times that stretch into months and surcharges that defy logic. This is the death of price discovery as we knew it, replaced by a chaotic two-tier system where the haves hold the metal and the have-nots hold worthless digital promises. The gap between these two worlds is the primary weapon used by the banking elite to discourage the public from exiting the fiat system. By keeping the paper price artificially suppressed through high-frequency algorithmic dumping, they create an emotional anchor of frustration for the average investor. You see the price drop on the chart, you feel the sting of loss, and you are manipulated into selling your physical holdings back into the very hands that are desperately trying to replenish their depleted vaults. This is a psychological operation designed to keep the exit doors narrow while the smart money quietly builds a fortress of physical bullion behind the scenes. Industrial buyers are now finding themselves in a lethal competition with retail stackers and sovereign wealth funds for the dwindling scraps of available supply. A Tesla or an Apple cannot build its products with a paper contract. They require the physical atoms of silver, and they are now realizing that the COMEX cannot fulfill their needs. This realization has triggered a panic buying phase at the institutional level, where price is becoming secondary to availability. When a multi-billion-dollar corporation decides that it cannot risk a production halt over a few dollars per ounce, they bid whatever is necessary to jump to the front of the line, further widening the chasm between the paper spot and the real-world cost of acquisition. We are seeing the emergence of a shadow market, where silver is traded at massive markups far away from the prying eyes of Western regulators. In this arena, the lie is exposed daily. There is no silver available at the quoted COMEX price, and there hasn't been for a significant amount of time. If you tried to buy 10,000 ounces at the current spot price for immediate delivery, you would be met with a wall of force majeure clauses and cash settlement offers. They will give you the devaluing paper currency, but they will not under any circumstances, give you the metal because they simply do not have it to give. This scarcity is being masked by leasing, a process where banks lend out the same bar of silver to multiple parties simultaneously to create the illusion of plenty. It is a game of musical chairs, played with one chair and 1,000 participants, and the music is starting to slow down. When the first major participant demands their physical bar and finds it has been pledged to 5 other people, the entire facade of the LBMA will collapse in a matter of hours. The lie is that the system is liquid. The reality is that the system is a dry husk, waiting for a single spark to ignite a total delivery default. The emotional anchor of this crisis is the growing anger of the common man who sees the elite hoarding the very assets they tell the public to avoid. JPMorgan's massive stockpile is not a trading position. It is an insurance policy against the very system they helped build. They know that when the currency dies, the only thing left standing will be the hard assets that cannot be printed, deleted, or devalued by a central bank decree. The window to buy silver at any price is closing as the market transitions from a price-driven environment to a supply-driven, one where the only question that matters is, do you have it? The true engine behind this disappearance is not just a few savvy investors. It is a global industrial machine that has finally run out of runway. For years, the market relied on a steady stream of secondary supply and scrap to bridge the gap between mine production and demand, but that buffer has officially evaporated. In 2024 and 2025, we witnessed a cumulative deficit exceeding 600 million ounces. And as we enter 2026, the industrial vacuum has reached a state of perpetual hunger. The silver that once sat in JPMorgan vaults as a market-making tool is now being requisitioned by tech giants who realize that without physical atoms, their digital empires cannot function. Every solar panel, every high-performance electric vehicle, and every AI processing chip requires a specific, non-negotiable amount of silver for its conductivity and thermal management. In 2025, the solar sector alone consumed nearly 30% of the world's total silver supply, a staggering jump from just 11% a decade prior. Manufacturers have tried thrifting, using less silver per unit, but the sheer volume of global installations has overwhelmed these technical savings. We are no longer talking about growth. We are talking about a structural shift where the energy transition is effectively eating the world, its silver reserves, alive. As AI data centers expand from 60 gigawatts to a projected 180 gigawatts, the demand for high-end circuitry and silver-coated connectors is skyrocketing behind closed doors. This is why you see massive, quiet drawdowns in the LBMA vaults. It's not retail buying, but direct industrial offtake agreements. Companies are now bypassing the COMEX entirely, realizing that a paper contract won't help them build a server farm or a satellite array. They are going straight to the source, signing multi-year contracts with miners that ensure the silver never even touches the open market. The evidence is stacked in the bank filings and the plummeting warehouse reports that show a 70% decline in registered silver inventories over the last 5 years. While the headlines focus on interest rates, the off-headline reality is a market where lease rates have spiked to decade highs because no one is willing to lend their metal. When the cost to borrow silver jumps from 1% to over 7%, it is a flashing red light that the plumbing of the financial system is blocked. There is plenty of paper, but there is no movable metal left to satisfy the immediate needs of a world that is digitizing and electrifying at breakneck speed. Mine production is not coming to the rescue, as global output has been stagnant or declining since its peak in 2016. Major primary silver mines are aging, ore grades are falling, and the regulatory environment in countries like Mexico has made new exploration a bureaucratic nightmare. This is the supply snap. The moment when the world realizes that even at double or triple the current price, you cannot simply flip a switch and create more silver. The lead time for a new mine is 10 to 15 years, while the lead time for an industrial shortage is 10 to 15 minutes. JPMorgan's vault levels are the ultimate barometer for this crisis, and their steady depletion suggests the lender of last resort is running low on ammunition. The industrial giants have outbid the speculators, and the central banks have outmaneuvered the retail public. We are moving into an era of backwardation, where the price of silver today is worth significantly more than a promise of silver tomorrow. This inversion is the market's way of screaming that the future has already arrived, and it is made of solid, scarce, and unavailable metal. Section 4. The Eastern Arbitrage and the Great Divergence. The most damning piece of evidence is not found on the New York ticker, but in the widening chasm between East and West. As we enter 2026, a great divergence has shattered the global pricing model, with physical silver on the Shanghai Gold Exchange consistently trading at massive premiums over the COMEX. While Western traders were distracted by paper liquidations, Eastern entities were aggressively arbitrage loading, literally draining 1,000-ounce bars from London and New York vaults to satisfy an insatiable physical appetite in Asia. This isn't just a price gap. It is a physical migration of the world's silver supply toward a system that actually values the metal as a strategic asset. The smoking gun arrived on January 1st, 2026, when China officially enacted a restrictive new export licensing regime for silver. By reclassifying silver from a common commodity to a strategic material on par with rare earth elements, Beijing has effectively ring-fenced 65% of the world's refined silver supply. This move was the ultimate quiet event, unreported by major Western news outlets until the industrial shortages became impossible to ignore. China, the world's dominant refiner, is no longer willing to export its silver for devaluing dollars. They are keeping it to fuel their own AI, solar, and defense sectors, leaving the West in a state of terminal supply shock. The numbers in the bank filings confirm this off-headline panic, showing that COMEX registered inventories have plummeted by nearly one-third in the final quarter of 2025 alone. As the West tried to suppress the price with massive paper shorts, the East responded by simply buying the physical metal and taking it home. This created a state of backwardation so severe that spot prices in Tokyo and Dubai hit 130 per ounce, while the official paper price in New York was still struggling to break 80. The plumbing of the global market is now officially broken, and the price discovery mechanism has moved from the futures pits of Manhattan to the physical vaults of the East. Even the most conservative institutions have been forced to revise their quiet internal projections as the evidence of delivery stress becomes overwhelming. We are seeing leasing rates for silver stay at elevated levels for months on end, a phenomenon that only occurs when the physical market is bone dry. Large-scale industrial users are now bypassing the traditional exchanges entirely, going directly to mining companies to secure off-market supply at prices the public never sees. This creates a hidden market where the true cost of silver is far higher than the $70 or $80 quoted on your screen, a reality that will only be revealed when the next major delivery failure occurs. Industrial demand from the AI revolution has acted as a silent vacuum, consuming silver for high-efficiency cooling and advanced circuitry at a rate that mine production cannot match. With global output down 3% in 2025 due to declining ore grades and a lack of new projects, the math for 2026 simply does not add up. There is no secondary supply left to tap, as years of deficits have already drained the surplus stockpiles that used to cushion the market. The banks are no longer managing a market. They are managing a shortage, and their only remaining tool is to hike margins to force smaller players out of their positions. The trigger for the final snap is already being pulled as sovereign wealth funds begin to enter the fray, realizing that silver is the critical mineral of the next century. In late 2025, the U.S. government quietly added silver to its list of critical minerals. Yet the irony is that most of that supply is now controlled by the very nations the West is in competition with. The quiet drawdowns, the massive premiums in Shanghai, and the drying up of the COMEX all point to one inevitable conclusion. The world is waking up to the fact that you cannot print silver, and the people who realized this first have already emptied the vaults. The snap occurred not with a whimper, but with a total violent seizure of the global arbitrage mechanism on January 1st, 2026. On that day, the world woke up to a reality where silver was trading at three distinct, irreconcilable prices: $71 in New York, $80 in Shanghai, and a staggering $130 in Tokyo and Dubai. Under normal conditions, an $8 spread is closed in hours by traders moving metal from cheap to expensive, but the spread remained open because the metal simply cannot move. China's new export licensing regime has effectively locked the vault, ring-fencing 65% of global refined supply behind a government stamp that Western banks cannot bypass. The trigger was pulled when the Shanghai Gold Exchange increased silver margins to 20%, signaling that the East was no longer interested in paper speculation, but in final, physical settlement. In the West, the CME Group was forced to halt trading repeatedly as buy orders overwhelmed the liquidity of the market-making banks. These halts weren't just cooling-off periods. They were the sound of a gears-grinding failure in a system that had promised 378 ounces for every single physical ounce in its vaults. The paper-to-physical ratio has reached its breaking point, and the banks, led by a pivot at JPMorgan, have finally stopped fighting the tide and begun front-running the inevitable reprice. JPMorgan AS position has flipped from the world OS largest short seller to its most aggressive physical long, a move that confirms the game-over scenario for the shorts. They are no longer protecting the dollar. They are protecting themselves by vacuuming up the remaining eligible silver before it is reclassified as strategic by Western governments. When the primary architect of silver suppression switches sides, it is a signal that the suppression is no longer profitable or even possible. The quiet accumulation by the major banks is the final piece of evidence that the paper game has been abandoned in favor of a hard asset fortress. In the streets of Tokyo, the 130 price point is not a speculative spike. but the real-world cost of acquisition for a factory that needs silver to keep its production lines moving. This is the great disconnect, where the Western spot price has become a hollow settlement number for leveraged speculators, while the Eastern price reflects the actual value of an atom in an AI-driven economy. If a factory in Japan is willing to pay double the COMEX price, it is because they know the COMEX is a lie. They are bidding for survival, while New York is still trading claims on ghosts. The divergence is the market's way of admitting that the price discovery mechanism of the last 50 years has died. We are now in a resource war, where the winners are those who hold physical delivery and the losers are those who hold digital promises of future delivery. The door to the silver market didn't just close on January 1st. It was welded shut by a geopolitical reality that values atoms over algorithms. The paper shorts are now trapped in a burning building with no exit, as the long banks prepare to profit from the very volatility they use to suppress. This is the moment the system snaps. The realization that the 100-year-old game of selling silver you don't own to people who don't want it is officially over. The physical market has finally overwhelmed the digital illusion, and the resulting vacuum is sucking the remaining value out of every paper currency on the planet. We are seeing a sovereign-level scramble for the last remaining ounces, as nations realize that silver is the critical mineral of the new century. The snap, yes! Snap is the sound of the world's financial plumbing breaking under the weight of a physical demand that cannot be printed or programmed away. The climb from $50 to $100 will not be a smooth ascent. It will be a series of violent gap-up ladders where the price resets overnight while markets are closed. We are entering the phase of industrial bidding wars, where a single aerospace contract or a national solar mandate can wipe out an entire week's worth of global mine production in a single afternoon. When a sovereign entity like a G7 nation or a BRICS Plus powerhouse decides to add silver to its strategic reserves, they don't buy through a retail brokerage. They enter the market with a price incentives mandate that shatters the remaining resistance levels. As the $80 barrier is breached, we will see the pension fund entry, a massive wall of institutional capital that has been legally barred from the market due to volatility now forced in by the sheer necessity of a hard asset hedge. These funds represent trillions of dollars in stagnant wealth that will suddenly chase a physical market that is only a few billion dollars in size. The result is a mathematical impossibility. More dollars chasing fewer ounces than at any point in human history. This is the moment silver transitions from a speculative commodity to a sovereign Tier 1 asset, traded and hoarded with the same intensity as enriched uranium or high-grade crude. The future is no longer about trading silver. It is about possessing it as the ultimate insurance policy against a collapsing digital ledger. You must stop watching the spot price, which is nothing more than a manipulated dashboard, and start watching the supply delta, the gap between what the world needs and what the world can actually pull out of the ground. The story isn't over, but the era of cheap, accessible, and plentiful silver is a memory that will soon be studied in history books as the greatest mispricing of the 21st century. Stay informed, watch the vaults, and remember that in a world of infinite paper, the only thing that matters is what you can touch. History doesn't repeat. It leaks quietly, through markets, metals, and money.